Dear investor, in this edition, let us discuss the following topics. First, the next theme, last time we discussed one theme, this time let us discuss if premiumization as an investment theme continues. Second, discussion on valuations, whether it is right to be cap focused, how much is the impact of growth on valuations. Third, we will focus on risks that we foresee just now in the marketplace. And lastly, yes, our portfolio positioning in the new fiscal. In the last edition, we had discussed the China Plus One theme and saw it working. In this edition, let us look at premiumization theme. Higher incomes have driven consumption in India over the last decade. Middle class households, which now represent over 30% of the population, has enjoyed strong annual growth from 95 onwards, leading to the bulk of expansion in the premium categories. Now, with the growth of the economy, the growth in the middle class is expected to continue, and this should continue to provide a tailwind to this trend. In percentage terms, the increase in the number of rich and super rich households have been larger versus other cohorts. Savings during COVID and changed outlook towards saving versus celebrating the present have further provided tailwinds. As a result, growth in premium products has expanded at a faster pace than mass market equivalents across most categories, notably in consumers, autos, and real estate. While the trend was visible and anticipated earlier, there were very few companies to invest because space was nascent and the companies were very small. So this is changing as we speak, and we have some good selection of companies to invest in this space. The trend is seen in various spaces. In consumers, for example, the trend is seen in jewelry, toothpaste, footwear, soaps, biscuits, detergents, and other categories. In these categories, the growth in the premium products is nearly 2x the growth of the entry level counterparts. In autos, the trend is towards more expensive SUVs, deluxe motorcycles, and now more towards EVs and hybrids, which are more expensive. Manufacturers who had a larger share of these categories have done relatively better. Premiumization trend is visible in property markets as well. Sale of premium segment, over 1 crore houses has increased sharply. Share of premium apartments in the total sales has increased from 18% to over 30% in the 19 to 22 period. The average home purchase ticket size has also gone up in the same period. Coming down to the next topic, valuations. Now let's do it differently this time, make it more theoretical. Now, discounted cash flow is the best method to value a business, while it does suffer from some difficulties such as projecting for the long period. It basically says that if all the future cash flows of a business are discounted back to the present at the required rate of return of the investor, the present value of the enterprise, which is appropriate for the investor, would be obtained. If the price in the market is higher than the present value, then the investor should hope to make lower returns than his required rate of returns, and vice versa. Let us look at the sensitivity of valuations in an example where we project for just about 10 years and don't take any terminal value, which we believe is a very conservative assumption. The thought is that after this period, the growth rates would converge with the economic growth rates. Again, a conservative assumption. Now, what we see on these conservative assumptions is a 26% change in valuations, where when we take long period growth at 15% versus 20%. Which means that give or take every percentage change in growth assumptions for a 10-year period results in 5% change in valuations. Now, if we look at the growth levels seen in various parts of the market, we find that in the period 2008 to 2021, large caps were the fastest growing part of the market. Large cap index grew earnings at 5% versus 4% for mids and 2.8% for smalls. Higher growth enabled large caps to enjoy better valuations in this period. In fact, FMCG index saw earnings at over 2x the growth of the Nifty and performed strongly during this period. The earnings leadership has changed from the bottom of the COVID. If we look at the growth rates of various parts of the market after COVID, we find that the mid and small cap earnings growth rate has been significantly more than the larger caps. The growth rates have been 22, 36, 48 for percentage for large, mid and small cap indices over this period. While the gap in growth rates has narrowed down in financial 24 and may narrow down further going forward, we believe as long as it remains meaningful, which is our base case, theoretically, mid and small cap spaces should be able to trade at a premium valuations versus larger caps. This would be a change versus historical trading patterns. However, these spaces are less liquid versus larger cap spaces, and liquidity risk is definitely higher. We do believe that the higher earnings growth of mid and small cap segment should sustain. A significant contributor to the sharp difference in growth trajectory pre and post-COVID has been reverse globalization and China plus one sentiment. US itself wants to move manufacturing back to the US and is incentivizing domestic production. This is enabling other countries, including ours, to also extend incentives and benefits to domestic and MNC businesses to set up new ecosystems such as electronics, chemicals, etc. in the country to improve the manufacturing presence in the economy significantly. The presence of manufacturing focused businesses is higher in the mid and small part of the market, and this change is having a large bearing on their fortunes. Similarly, growth themes like luxury consumption, hospitals, new tech, engineering and defense are themes which have emerged over the past few years and are more represented in the mid and small cap space. We are growth focused investors, and as a process, we have kept our focus on these themes to ensure both good longevity of growth and quantum of growth in our portfolios. Let's now look at the risks that we see in the system, and ultimately we will speak of our portfolio positioning. In our past editions, we have discussed several risks such as oil prices, geopolitical risk of higher yield sustaining for longer, etc., and have concluded that as yet the risks are within tolerance limits, and we shared the tolerance limits as well. At this juncture, the risk in focus is the valuation risk in the small and mid cap space and the illiquidity risk associated with this space. We have tried to address the valuation risk in this section before and concluded that if the growth rates in the small and mid segment sustains at higher levels, there is a great chance that this space could continue to command premium valuations. The lower liquidity associated with the mid and small space is a real risk, and some funds in this category have seen strong scale up, which is resulting in a concentration risk of another kind. So for example, what happens if a fund which is large gets large redemptions for any reason, and the cascading effect the same may have on other funds. As of now, we believe we are less impacted on account of this risk because, one, our AUMs are as yet not very large and we retain the ability to change names. We have demonstrated that in our funds. And two, our funds have very low percentage overlap with other funds in the competing category. So, we really hope to sidestep the domino effect if at all that risk comes into play. While we run focused high conviction portfolios, we have made sure that our liquidity profile in our funds is generally speaking quite competitive with that of the peer set fund houses. And we hope to keep the focus there. So even as we gain scale, we would want to keep the liquidity good for our funds. Now coming down to the next risk, we are moving towards election and nearer to the full budget. The policy risk around taxation of equity gains would again come into focus as we get closer to the budgetary process. Let us share some of our thoughts. One, is there a need to do anything just now, given that the tax buoyancy is strong and collections are over the budgeted numbers? Two, there is lower taxation of FPIs on the F&O part already, and the new gift city route, where even the cash trades or investments into mutual funds could potentially attract lower taxes. So, one set of investors are being given better tax treatment through this route. Third, expectations of higher taxation is on account of the thought that one should achieve tax convergence with other asset classes. However, look at it this way: convergence would mean fungibility of profits and losses between asset classes, and also removal of STT on equity trades. This would mean that the predictability of revenues for the government reduces, given that STT happens irrespective of anybody making a profit or a loss, and overall collections may not increase. Fourth, while collections may not increase, a correction in the equity markets to the tune of say 7 to 8% logically, as the required rate of return would move up, and maybe more on account of sentiment should be expected. Fifth, domestic investors have only recently started to come into the equity market and are providing a spine to the market and enabling startups, small caps, mid caps, and large cap businesses to raise money, fueling economic growth. If the domestic flows are impacted, we could again see higher influence of FPI money, as was the case in the past, increasing uncertainties for corporate India also in the process. Higher equity flows to corporate India has kept debt to equity healthy this time around versus the 2000 to 2008 period. Now, just to note, even countries like Japan have provided free tax or lower tax route to domestic investors to come to the equity markets. We thus believe that equity tax increases, while possible, does seem to be a lose-all proposition at this point in time and should be seen as a low probability event. Coming down to the next topic, how are our portfolios positioned for the new fiscal? We have been touching on this, we'll keep it short. We are quality and growth focused investors. We had noted in our Jan 1st edition that we believe that the growth themes in the next fiscal would continue to be what were the themes in financial 24, though the drivers may be different. For example, in the capex theme versus the government driving capex, the baton could pass on to the corporates. We have tried to include all growth themes in our portfolio. Growth themes meaning spaces in the market where growth in earnings is expected to be in excess of the index earnings. In these spaces, we have some of the highest earnings growth businesses where valuations make sense, and we believe this would help our portfolios to participate well in the market. As different spaces move, something in the portfolio should be moving as well. A large earnings growth delta with competitive valuations versus the index is our primary source of alpha. We believe next fiscal continues to be a period for alpha because the growth in the broad market continues to be stronger than the large cap spaces. In the new fiscal, which is just beginning, we should see regulated interest rates drop in India and in the Western economies. That's a big hope for this fiscal. Lower interest rates are positive for growth businesses in particular, while being generally positive for growth asset class like equity. We believe that lower interest rate would provide further tailwinds to our portfolio in the new fiscal over time. Thank you. Happy investing and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.